Hi Dr. Phua, my name is Ong Jin Wei and today we are going to present about our financial accounting assignment. And before that, I would like to introduce my group members that are Ong Sin Yee, Jocelyn, Wong, Ching, Ong Jin Wei, Loo Kar Wai, and Yap Jin Cong and Tay Ming Cheng. This assignment analyzed the performance of 8 companies for 3 years that are 2020, 2021, and 2022. The selected companies are 7-Eleven Malaysia Holdings Berhad, Berjaya Food Berhad, One Growth Group Berhad, Pan Malaysia Corporation Berhad, Genting Malaysia Berhad, Leong Hook International Berhad, Hua Thai Industry Berhad, and Bershom Holdings Berhad. So we collected the financial data from each of the company mentioned just now and conducted ratio analysis. And based on the analysis, we choose the best and the worst company to be compared that are 7-Eleven Malaysia Holdings Berhad and One Growth Group Berhad. So these are the 14 ratio analysis we conduct, analyze and compare between the 2 companies.
So first of all, gross profit margin represents the percentage of revenue retained by a company after deducting the cost of goods sold from its total revenue. As we can see from the graph, the gross profit margin of SEM is more stable than One Growth because it only fluctuates around 37% to 28% within the 3 years. However, when we look at One Growth, the gross profit margin is very unstable. It increases around 32% during year 2021, but then drops to negative 98.85% during year 2022. Thus, we can conclude that SEM has a more stable and larger gross profit margin earned from each dollar of sales.
Now, I'm going to talk about the ratio analysis, which is the net profit margin. First, net profit margin reveals the percentage of net sales revenue a company has after paying the operating expenses and costs. It indicates a company makes how much net income from total sales is achieved. The net profit margin is computed by net profit divided by net sales. Based on the data collected, we can see that the net profit margin of 7-Eleven Malaysia growing from 1.39% to 2.24% in the years 2020 to 2022. One growth rises from a negative value, which is negative 66.9% to negative 16.73% from the year 2020 to 2021. However, One growth decreased to negative 135.23% in the year 2022. Hence, 7-Eleven is more stable compared to One Growth because it has a positive and higher net profit margin. It means that 7-Eleven is more efficient at converting sales into actual profit. Next, the ratio analysis is return on total assets (ROA). This ratio indicates how profitable a company is to its total assets. It is used to determine how efficiently a company uses its assets to generate a profit. Return on total assets is the net profit divided by the average total assets invested. According to the data, the ROA of 7-Eleven Malaysia grew from 2.04% to 3.41% from the year 2020 to 2022, while the ROA for One Growth was negative 15.58% in 2020, increasing to negative 8.64% in 2021, but decreasing to 12.84% in 2022. Therefore, 7-Eleven Malaysia has performed well compared to One Growth because it has a higher value of return on total assets ratio. So, SEM is more efficient and productive in generating profit with each RM invested in the company assets.
Next, I would like to talk about return on equity. It is considered as a gauge of a corporation's profitability and how efficient it is in generating profit from its shareholders' investment. Based on the data, 7-Eleven Malaysia Holdings Berhad showed an increase from 26.85% in 2020 to 34.28% in 2021 and an increase in 2022 of 40.91%. One Growth Group Berhad shows a negative return on equity in these 3 years. So, the data shows that 7-Eleven Malaysia Holdings Berhad performed better and was more efficient at generating profits from its shareholders' investment. The next analysis ratio is price-earnings ratio. It is the relationship between a market price per share and earnings per share. So based on the data, the price-earning ratio for 7-Eleven Malaysia Holdings Berhad was 0.5 in 2020, decreased to 0.37 in 2021, and continuously decreased to 0.24 in 2022. Whereas One Growth Group Berhad had a negative and smaller figure for price-earning ratio in these 3 years. So 7-Eleven Malaysia Holdings Berhad is more likely to be chosen since the price-earning ratio is higher, although it decreases in 2021 and 2022. The higher the price-earning ratio of SEM shows that more investors are willing to pay for its higher share price and showing higher confidence in its prospect.
Price-book ratio is the company current market price per share divided by book value per share. A lower PB ratio could mean the share is undervalued and worth to buy. The information showed that SEM price-to-book ratio dropped from 2.22 to 1 in 2020 to 0.12 to 1 in 2022. One Group price to book ratio grew from 3.5 to 1 in year 2020 to 4.5 to 1 in 2021 and dropped to 0.87 to 1 in the year 2022. Dividend yield is the amount of cash dividend allocated to the ordinary share relative to the market price per share. The dividend yield of 7-Eleven Malaysia Holding Berhad dropped from 1.77% in 2022 to 1.1% in 2021 and then jumped to 1.86% in 2022. And One Group did not distribute any cash dividend to ordinary shareholders.
So here coming to the debt ratio always refers to the extent of company leverage. In other words, it's the proportion of assets paid for liabilities. So a company with a high debt ratio is exposed to the risk of cash flow constraint and may incur reluctance from lenders to extend our financial support. Among the 3 years, 7-Eleven Malaysia recorded almost the same debt ratio with 0.92 at the first 2 years and slightly dropped to 0.91 in year 2022, but is still considered at a high risk level compared to One Glove drop from year 2020 0.77 to year 2022 0.56.
Tied interest earned is a measure of a company's ability to meet the company debt obligation based on its current income. This means the more tied interest earned ratio means that company have higher ability to pay back the debt. Based on the data, the tied interest earned ratio for 7-Eleven Malaysia Holding Berhad was increased for 2.17 times in 2020 to 2.5 times in 2021 and continuously increased to 3.19 times in 2022. We said that One Glove tied interest ratio was negative 4.64 times in 2020 and increased to negative 0.03 times in 2021 and decreased to negative 5.07 in 2022. This indicates that 7-Eleven have high ability to pay back the debt as compared to One Glove.
Now is the current ratio, which is a financial ratio that measures a company's short-term liquidity. It is calculated by dividing a company's current assets by its current liabilities. The current ratio of 7-Eleven Malaysia Holding Berhad (SEM) in the year 2020 was 0.63 times and increased to 0.89 times in the year 2021 and continuously increased to 0.96 times in the year 2022. The current ratio of One Growth in the year 2020 was 0.19 times and increased significantly to 2.23 times in the year 2021 but decreased to 0.99 times in the year 2022. Overall, SEM has a quite stable short-term liquidity, but this is opposite to One Growth as their current ratio has huge fluctuation in these 2 years. Next is asset test ratio, which is a liquidity ratio that measures a company's ability to pay its short-term obligations. It is calculated by dividing the amount of current assets that are already minus inventories and prepayment by the current level. The asset test ratio of SEM in the year 2020 was 0.31 times, and in the next year increased to 0.43 times, then increased again to 0.55 times in the year 2022. While for One Growth in the year 2020 was quite low, that is 0.15 times, and in the next year increased significantly to 1.4 times, then decreased to 0.23 times in the year 2022. In comparison, SEM has more ability to pay its obligations in the year 2020 and 2022, while in the year 2021, One Growth is more capable of paying its obligations.
Inventory turnover actually measures the number of times a business sells and replaces stocks of goods during a given period. Based on the data, SM recorded with average 6 to 7 times inventory turnover from year 2020 to year 2022. Comparing to SEM, One Glove only recorded the inventory turnover with 5.48 times in year 2020, decreased to 1.098 times in year 2021, but increased back to 2.49 times in year 2022. Each has proven that SM generates well in their sales, which bring to more frequent times in the inventory turnover comparing to One Glove. Next, account receivable turnover measures the number of a company collects its average account receivable balance. Based on the analysis of data, SM recorded 115.53 times for its account receivable turnover in year 2020, decreased to 60.82 times in year 2021, but increased to 63.93 times back in year 2022. At the same time, One Glove only recorded 1.47 times in year 2020, increased to 5.99 times in year 2022. This has proven that SM has a higher proportion of quality customers who pay their debts quickly compared to One Glove. Account payable turnover actually measures how quickly a business makes payment to the creditors and suppliers. Based on the data, SM recorded with average 4 to 5 times of account payable turnover from year 2020 to year 2022. Whereas for One Glove, the annual report of the company did not show any amount of account payable figure in it for year 2020 and 2022, but only showed the figure for year 2021. Hence, it recorded 3.04 times for account payable turnover in year 2021. So if a company does not show any account payable, it actually means that the company does not owe any money by the year. In short, SM is more effective at paying back the creditors than One Glove.
So coming to the next part is the corporate governance analysis. Based on our studies, we found that one of the most important part is directors' remuneration. In summary, Genting Malaysia Berhad offers the highest director remuneration, while Pan Malaysia Corporation Berhad provides the lowest pay. So in comprise salaries, allowance, fees, and additional benefits to the directors. The remuneration paid to the directors is to establish their contribution and motivate them to provide better performance for the companies, like manage the sales well, increase the revenue and profit, set the goals and objectives of the company, and so on. Furthermore, next part to be considered is the CEO duty. CEO duty is a business practice where the CEO of company serves as a chairperson of the building. So basically, the adoption of CEO duty is uncommon among companies due to the associated risk more than the potential benefits. For instance, the concentration of power can lead to potential abuse, lack of check and balance, and decision may not always be the best interest of the company and stakeholders. So on that account, there have no cases of CEO duty founded among these 8 companies.
The age of a CEO reflects their wealth of experience and long-term vision in the business world. In the case of Pan Malaysia Corporation Berhad, sales increased from 30 million in 2021 to 100 million in 2022 because of the experience of CEO.
Next, we found that the number of board of directors for these 8 companies are different. A board of directors is the governing body of a company, whose members are elected by shareholders to set strategy, oversee management, and protect the benefit of shareholders. Hence, the number of board of directors can directly affect the company performance. Based on the data, the most number of board of directors for year 2020 and year 2021 is Yong International Berhad, while the least number of board of directors for year 2020 and year 2021 is One Group Berhad and Thai Industry Berhad. Furthermore, in year 2022, Genting Malaysia Berhad has the most number of board of directors, and there are 3 companies have the least number of board of directors. These 3 companies, One Group Berhad, Pan Malaysia Corporation Berhad, and Thai Industry Berhad. Based on the data, we found that the more number of board of directors of a company, the performance of a company will be more excellent.
To sum up, in the ratio analysis part, when calculating the profitability ratios, market ratios, long-term solvency ratios, and inventory turnover rate, SEM shows a more stable ratio. All the ratios remain positive and some of them even keep increasing every year. However, in calculating the short-term liquidity ratios, both SEM and One Glove shows normal, which is no good or no bad. On the other hand, during analyzing of corporate governance, a business with high successful rate and long-term sustainability is said to be operate without CEO duty. Suggested number of board directors is between 5 to 10 and efficient in controlling the budget of remuneration paid to directors. As a result, since SEM was the closest to the criteria among the 8 companies, it is said to be having an excellent business performance. So that's the end of our group's presentation. Thanks for your listening and your patience.